It is Friday, May the 8th, and welcome once again to your Guide Through the Storm. I am Bob Simpson, your host for this series of webinars. Thank you for joining this, the 8th webinar in our series, and thanks to those of you who have shared your appreciation for these webinars. We want you to know that we listen to your thoughts regarding topics and feedback, and that we've received about this webinar series, and based on your feedback, our focus today is on real estate, and we're excited that the number of people who registered for this webinar is the largest number that we've had so far to date. So thank you very much for joining us and inviting your friends and colleagues. Now, real estate is a broad topic, and we have a ton of information to discuss on today's roundtable. So let's just jump right in and let's get things started. So over the past 2 months, we've been doing a lot of analysis and research on our portfolios, led by Paul Tyers, the senior portfolio manager, and the Portfolio Stewards Investment Committee. And we've made some significant changes as the world has changed due to the coronavirus pandemic. We've been replacing some of the underperforming parts of the portfolio. We've been taking advantage of tax loss harvesting, as we discussed in a previous webinar. We've identified new opportunities, and as the market has recovered, we've taken a slightly more defensive stance. Now, one shift that we've been making is to go from a more passive approach to a more active management approach, as we discussed in our last session, where we chose Paul Sandu and Merit Investments to manage some of your fixed income investments. Now, most recently, we've turned our attention to the real estate portion of your portfolio, and we've chosen Signature Global Asset Management, a top performing active manager focusing in on the public real estate markets for a portion of your portfolio. So let's turn to today's panel. Joining me on the panel today are Paul Tyers, a regular panelist and somebody that most of you know very well, and Kate MacDonald, portfolio manager with Signature Global Asset Management. So Paul and Kate, welcome.
Thank you, Bob. Glad to be here.
Now, we record these webinars, and the recordings are available at www.portfoliostewards.ca. And we also encourage your questions. So if you have a question, please use the Q&A button in this program to type in your questions, and we will be glad to address them. Now, the theme of these sessions has been tracking the storm. And we addressed this a number of times, but we haven't looked at it most recently. But, I can think back to March the 20th to 27th, when the coronavirus was growing at 618% per week. That had a significant drop in early April to 180%. And now we're down to, in Canada, 21%, in the United States, 17% weekly growth. So the curve is flattening, and we're starting to get some information from the governments that they're starting to open things up. And we'll see how that goes, and hopefully we can avoid a next wave that occurs in the coronavirus. Now, this is a chart that we've been updating every week, and we've identified two major parts of the, as markets have evolved over the last few weeks. So the first is the storm, where we can see we had the -14, -8, -11, and -12% weeks. And then we entered into the next phase, which I called recovery, where we've had 3 weeks out of 4 with positive returns, 2 times in double digits. And now we have a portion that I'm calling uncertainty. For the last 3 weeks, slightly negative, given up 1.3%, 0.19%, and -1% over the last 3 weeks. So we're now in a period where things are not quite so steady, and that has led us to taking a slightly more defensive stance in portfolios. You can see the chart on the left is the S&P 500, which had a significant drop, a good recovery, and it's been sideways. And pretty much exactly the same chart for the TSX 60 to date. From February 20th, the S&P 500 is still down 14% and the TSX is down 16.5%. Now, our portfolios have continued to perform relatively well. Our moderate conservative portfolio down -6%, balanced portfolio down about 7% year to date, and the moderate growth portfolio is down about 8%, and that compares to the year to date numbers for the TSX 60 at -13% and the S&P 500 down about 11%. So turning our attention to our guest panelist today, Kate MacDonald joined Signature Global Asset Management in 2018 as a portfolio manager responsible for a number of dedicated real estate funds, as well as real estate allocations across various strategies. Prior to joining Signature, Kate co-managed the award-winning real estate portfolios at First Asset for 5 years. She holds a master's degree in finance from Queen's University, the CIM designation, and the Chartered Financial Analyst designation. So Kate, once again, thanks for joining us. So let's kick things off, Kate, with question number one. So Kate, you run one of the largest real estate funds in Canada. Can you tell me a bit about your team that you work with?
Certainly. Well, thank you, Bob, and thank you, Paul. It's a delight to be here on the call today, and thank you to all of those on the line. Hope you're all well and enjoying working from home. So my name is Kate. I am an equity portfolio manager focused on global real estate and specifically on publicly listed real estate equities, including real estate investment trusts or REITs, real estate operating companies, and companies that provide services to the real estate industry. So allow me to introduce you to my team. So Lee Goldman, Joshua Varghese, and I collectively form the real estate team at Signature Global Asset Management, which is CI's largest in-house investment management team. And together we manage over $4 billion in publicly listed real estate or REITs, which actually makes ours one of, if not the largest REIT dedicated buy-side teams in Canada outside of the pension funds. And certainly what I've learned over the last 2 years is that scale definitely matters. It puts you on the map, and it has enabled corporate access and access to management teams and information that we would not have garnered as a smaller team.
Yeah, and that's great, and we appreciate that we have access to your expertise, which then you're gaining from the information you're gaining from the people that you work with. Now, what role does commercial real estate play in an investor's portfolio, Kate?
Well, great question, Bob. Now, across most property types, the revenue and cash flow streams underpinning commercial real estate are backed by multi-year leases and provide a high level of predictable, contractual, and generally growing income, which has made real estate a highly desired asset class by both institutions and private investors alike. Now, over recent years, institutional investors have steadily increased their allocations to real estate. And the rationale underpinning such investment is simple. Real estate, both public and private, and when I say that, I mean both publicly listed real estate and direct property, tends to have a low correlation with other asset classes, including stocks and bonds. Historically, real estate has provided predictable and growing income streams, and it also tends to offer higher yields than other subsectors of the market, highly sought after certainly in today's very low interest rate and yield-starved environment. So not only does real estate act as a portfolio diversifier, but it also enhances the overall yield of the portfolio. Bob, if you'd flip now to the next slide. Mm-hmm. So while real estate investment has fluctuated during periods of crisis, what we've seen is that the overarching trend has been towards increased allocations to real estate over time. Now, many institutional investors have been steadily increasing their allocations to real estate over the last number of years, with the global average target allocation to real estate reaching 10.5% in 2019. Now, publicly listed real estate, including REITs, offer many of the benefits inherent in direct property, including low correlation to stocks and bonds and regular income at attractive yields, along with the features of publicly listed stocks. So this combination results in a set of attributes that we believe makes a compelling case for strategic allocation to publicly listed real estate. Now, the past decade has seen a significant expansion of the publicly listed real estate market, particularly in the US, as new property types have emerged, including cell towers, data centers, and single-family rentals. Now, these non-traditional real estate sectors make up over half of the REIT market capitalization, boosting an investor's ability to achieve enhanced return and diversification benefits. And increasingly, these non-traditional sectors have garnered an increasing role within our portfolios.
So Kate, how have REITs performed versus other sectors over time?
Great question. So here we show annualized total returns by GIC sector for the period beginning December of 2002 through March of 2020. So importantly, we didn't cherry pick the state range. We went back as far as the GIC sector data allowed for each of the GIC sectors to the nearest calendar year end. Now, as you can see, real estate REIT returns have stacked up well on both an absolute and relative basis, generating annualized returns of about 9% for the period, and in fact outpacing most of the other sectors and leading the composite index returns by almost 300 basis points or 3 percentage points on an annualized basis. Since 2019, the capped REIT index, so that's the Canadian S&P TSX capped REIT index, has either matched or beat the performance of the TSX Composite Index in 9 of the last 11 years, or 82% of the time, a surprise to many, if not most. Now, given the COVID-19 situation and what we expect will be a protracted return to normalcy, we expect will remain in a low growth, low yield environment for what's likely to be an extended period, which historically has been the sweet spot for real estate from a total return perspective.
Okay, how do REIT yields compare to the other sectors?
Well, great. I see the next slide. Thank you, Bob. So as you can see, REITs are yielding just over 6% today on average. And REIT yields are trumped only by energy, where dividend sustainability is a key issue in our view. Over recent weeks, we've had a number of conversations with many of the REIT management teams. In light of COVID-19 and the pressure on the economy, our discussions have been laser focused on tenant health and covenant, property revenue and cash flow impacts, balance sheet health, available liquidity, and importantly, distribution sustainability. Now, with few exceptions, management teams view their distributions as sacrosanct and have ample capital and levers to pull, including scaling back on development projects and their pipelines, and also on non-essential capital expenditures to continue to fund the distribution over the next 6 to 12 to 24 months and beyond. An active approach to asset class and security selection, in our view, is increasingly important in the current environment, as COVID is no doubt creating significant challenges for both tenants and landlords. That being said, most property owners, and that includes most REITs, certainly in Canada and the US and outside of North America, do have ample liquidity to withstand impaired cash flows through the crisis, in our view.
So taking a look at pension funds, because many investors want to look at how pension funds invest their money as a way to guide them in theirs. How do pension funds invest in commercial real estate and in the REIT market?
Great question. So real estate is a principal component of most pension portfolios, used as a portfolio diversifier, a hedge against inflation, and as a reliable income generator. Over recent years, institutional allocations to real estate have continued to rise. And here's a good example: the Canada Pension Plan Investment Board, or CPPIB's asset mix. So here we show CPPIB's asset mix over time, so since 2010 to 2019. And if you take a look at the green bars, the dark green bars, while overall assets under management have tripled since 2010, CPPIB's allocation to real estate has increased by a factor of over 6 times to now represent just over 12% of CPPIB's total assets. In Canada, pension allocations to real estate more broadly, so including the other Canadian pension plans, the real estate averages about 13% of the total mix. And that number is expected to migrate higher over coming years. Certainly, OMERS is at the higher end with about 20% of its portfolio allocated to real estate. Now, taking it back to CPPIB, interestingly, in the 2019 annual report, CPPIB noted that they had recently established a listed real estate team to further enhance the risk-return characteristics of its direct real estate portfolio by investing in listed real estate, including REITs. So CPPIB's listed real estate mandate is to gain exposure to property types that are either absent or underrepresented in its private real estate portfolio, and to invest in situations where real estate exposure is fundamentally cheaper in the public market than it is in the private or the direct market, which undoubtedly, with the events that have transpired over the last number of weeks, is a dynamic that we're seeing across most geographies and property types today. Now, private investors are also looking for opportunities to deploy capital. In late March, Brookfield Asset Management, which manages real estate on behalf of institutional investors, including pension funds, published an update letter for its investors. And in the letter, Brookfield CEO Bruce Flatt noted that Brookfield has recently switched its focus for investments from the private or the direct market to the listed stock markets, and noted that there are a number of stocks trading at significant discounts to intrinsic value, and that Brookfield is increasingly focused on these opportunities. So while the next few months will no doubt be challenging for many landlords and property types, listed real estate is trading at meaningful discounts to our view of private market values, creating opportunities to take advantage of rare discounts on high-quality listed real estate that we believe will recover as activity resumes. Increasingly, well-capitalized investors, including pension funds and private investors like Brookfield, are looking for opportunities in the listed markets.
So, Kate, what types of properties do you invest in, and how are you thinking, as you look in your crystal ball and you look out at the different opportunities out there? What are you seeing?
Well, within the funds that we manage, we invest across the income-producing commercial real estate property types, including multifamily residential, office, industrial, retail, and seniors housing. We also invest in the non-traditional property types, which includes data centers, towers, single-family rental, cold storage, life science facilities, and self-storage. Today, by sector, we remain heavily weighted towards multifamily residential and industrial, and are very much underweight retail broadly, given headwinds associated with e-commerce, with a bias towards grocery-anchored or more essential service type retail.
So you mentioned e-commerce. As more and more consumers are taking to shopping online, what are the implications for the commercial real estate market?
So in Canada, e-commerce sales, and this stat surprised me, might not surprise you, but it certainly surprised me. E-commerce sales have more than doubled since COVID-19 was declared a pandemic in March. Now, in our view, even once measures to slow the spread of COVID-19 are relaxed, we do think that online sales will likely significantly exceed levels prior to the health crisis, which will no doubt further pressure the sales of bricks and mortar retail in favor of industrial and logistics real estate. Now, cell towers and data centers are also benefiting from the rise in e-commerce. Just think, each time you purchase an item online or on your cell phone, it sets a sequence in motion that travels through a network of cell towers, data centers, and logistics facilities, many of which are owned by the REITs. Now, these companies play an integral role in getting your package from the warehouse to your front door, and give investors a way to participate in the growth of e-commerce. And further, given the disruption in supply chains experienced by many businesses as a result of COVID-19, we're hearing increasingly that companies are shifting their model from just-in-time delivery to more of a just-in-case model, meaning that companies are likely to stockpile larger inventory levels. Now, more inventory means more requirement for industrial space, which should drive additional demand for both distribution and warehouse space over coming months and quarters. Now, prior to COVID-19 being declared a pandemic, national industrial availability in Canada was about 3%, which effectively is a record low. So given this limited availability of industrial space, paired with very strong tenant demand for industrial space, landlords had significant pricing power and rental rates were grinding higher, particularly in Toronto, which saw rental rate growth in the industrial market in the double digits over the last 12 months. Our discussions with local operators over recent weeks suggest that this upward pressure on industrial rent remains in the stronger markets, albeit at a slightly lower clip than we saw pre-COVID-19.
Kate, shopping malls are shut down right now as COVID-19 runs its course. What do you see as prospects for the shopping malls going forward?
Great question. So we've been bearish on shopping malls for an extended period. There's no doubt retail fundamentals, particularly for non-dominant fashion-oriented malls, were challenged coming into the COVID era due to e-commerce and rapidly evolving consumer preferences. And the current health crisis and government-mandated closures have only escalated these challenges. So as you mentioned, many malls and shopping centers have been closed. Many others are operating at significantly reduced capacity over the last number of weeks. And as a result, many retailers, and particularly those subject to government-mandated closures, including gyms, theaters, small retailers, and restaurants, are very much struggling. And some have been unable to pay rent. Now, many tenants, and weaker tenants in particular, may not survive, which will further pressure landlords' revenue and cash flow profiles for these shopping center assets. So consistent with our stance coming into the crisis, we have been biased in favor of the more defensive grocery-anchored neighborhood centers that have a high concentration of essential service type tenants, which have largely been open and operative and have continued to perform comparatively well through this health crisis.
So that's interesting. Now, what's your view on office use and demand going forward? Many companies have been forced to work from home or remote working solutions like we're doing today with Zoom or GoToMeeting over the recent weeks. Do you think companies are going to look to remote working in order to compress their real estate footprint?
Well, there's no doubt. Through this crisis, many companies have been forced into remote working solutions, as we have. And many have been pleasantly surprised by how effective and efficient this new working from home model has been, as we have. So with tools like Zoom and Microsoft Teams, it's really reshaping how companies view their physical office needs. And so that certainly is reshaping in the COVID era. So a number of companies have been very public and forthcoming with respect to their desire to scale back their physical footprint on a permanent basis. Short list might include Morgan Stanley, TD Bank, BMO, and OpenText, just to name a few. Now, a potential offset is the need for lower office density. So in other words, fewer employees per square foot of office space, as social distancing will no doubt require greater physical distance between workers and employees. So we do think that remote working solutions will likely reduce, but unlikely to eliminate demand for office space in the near to intermediate term. But it certainly has made us incrementally more bearish on office demand, definitely in the short term.
Yep. So if you're bearish there, what types of properties do you think are well positioned in the current environment?
Well, there's no doubt that properties or landlords that have portfolios of assets in the stronger markets. And when I say stronger markets, I mean those markets that have lower vacancy rates. So you think of Toronto, downtown office with vacancy below 2%. Very strong market coming in. We don't think that there'll be great disruption near term in Toronto because tenants may wish to retain their space because it's very difficult to find large swaths of available space. And landlords with long-term lease durations are also better positioned in the current environment. Now, one stat that we're watching extremely closely and are spending a lot of time discussing with local brokers is sublease availability. And so that means that if a tenant has space available that they're not using, they may look to sublease that space out. So when you start to see that sublease availability number start to increase, that's when you grow a little bit more concerned on the prospects of office in that node. Now, to date, we have not seen that, but it's something that we're watching for very closely.
So how is your portfolio positioned right in the current, as you look moving forward? You know, we don't invest for the past, we invest for the future. So how are you positioned in the current environment, and have you made shifts in your portfolio based on what you've seen over the past few weeks?
Well, certainly our investment approach has long favored quality, growth-oriented real estate companies with proven management teams, quality real estate, healthy, flexible balance sheets, and relative undervaluation versus peers in direct property. So our approach hasn't changed amid COVID-19. Fortunately, and by design, our funds were very well positioned coming into this crisis with double-digit cash positions, which provided cushion through the downturn, and concentration in the more defensive sectors, including multifamily residential, where apartment vacancies in Canada are well below 2% coast to coast. Industrial, which we just noted, is benefiting certainly from e-commerce and the desire to ensure supply chain resilience, and more defensive grocery-anchored retail. Now, perhaps while we're on this slide, I'll touch on two aspects of our security process, which are even more relevant today amid the challenges of COVID-19. So we've always focused on management quality, asset quality, balance sheet health, growth prospects, with an overlying wrapper of valuation. Now, in the current environment, real estate asset and portfolio quality is critical. So we've very much been biased in favor of real estate that will generate more resilient cash flows. So to do that, tenant health and covenant is a key risk to near-term operating performance. And as such, it's been something that we've been increasingly focused on over the recent weeks. Now, in addition to tenant health, healthy balance sheets and liquidity positions are also very important to ride out the storm. So we've long had a preference towards those issuers with prudent leverage and sustainable payout ratios that are both appropriate given the level of operating risk and consistent with the overall strategy of the business. Increasingly, we've been focused on those issuers with a high degree of liquidity, of significant unencumbered portfolios and levers to pull to weather the storm, and perhaps have the ability to play offense should the opportunity present.
So it's kind of looking back as we, are you seeing opportunities in the market today?
Well, one of the key valuation metrics we look at is price to net asset value, or price to NAV, which effectively contrasts how the REIT portfolio is trading on the exchange versus our estimate of the private market value of its properties net of debt. So this slide shows the average price to NAV by property type for the Canadian REIT universe that we track. And on average, Canadian REITs are trading at an eye-popping double-digit discount to our estimates of net asset value. So where we've generally viewed price to NAV discounts exceeding 10% as table pounding opportunities for patient long-term capital, we're well through that level today. That being said, much uncertainty remains about the depth, duration, and ultimate impact of this pandemic-induced economic crisis. And we do anticipate that market volatility is highly likely to remain elevated near term. That being said, the real estate companies were well positioned preceding the downturn. In fact, markedly better than we saw coming into the global financial crisis, with significantly higher occupancy levels and much better balance sheet and liquidity positions than we saw the last go around. So our recent conversations with management teams have provided a degree of comfort in their ability to ride out a difficult period over the next number of months. And given REIT's strong balance sheets, access to capital, and attractive valuations, we do think that the current environment presents a compelling opportunity to put capital to work for patient long-term investors like ourselves.
So Kate, one of the, my favorite book is a book called The Age Curve by an author, Kenneth Gronbach. who is a demographer marketing type. One of the things that he was talking about is in the United States, there, I think it was 88 million millennials are going to be coming into the marketplace. As you look at that, those kind of numbers, how is that going to affect the multifamily market?
Well, there's no doubt that a high degree of millennials are likely to form the rental population. So it's certainly that demographic reality has and will continue to drive very strong demand for apartments. We see that in Canada, we see that in the US. And really, the demographic profile is what has driven our bias towards multifamily residential, both in the US and Canada, and has underpinned that investment. So vacancy rates are low, and in that environment, landlords have had significant pricing power. Certainly in Canada, CMHC just came out with their recent report in January of this year, which showed that apartment vacancy nationally was sub 2% in Canada. Which is extremely strong. And when you have individuals looking for space and few apartments on the market, especially with apartments being the most affordable of the housing segment, it has been a perfect storm for landlords on the apartment side. Now, there's no doubt through this coronavirus pandemic and the fact that we've seen unemployment numbers rise, that growth is very likely to moderate. But we do think that the stimulus measures announced by the governments, both in the US and Canada, have and will continue to support a vulnerable tenant's ability to pay rent in the near term.
And the other side that we might look at is that people will have less ability to purchase properties moving forward, and that might add additional demand for people wishing for rental properties. Now, we have a couple of questions. We're now in the Q&A portion. Kate, thank you so much for your thoughts here, and hopefully you can hang out with us for a few minutes to answer a few questions.
Yes, I'd be glad to.
Yeah, we did have a question that was sent, and you kind of touched on it, but I just want to make sure we address it directly. And the question is, with the news this morning that unemployment in Canada is now 13%, has that altered your outlook for real estate in the GTA in any manner?
No, it hasn't. And certainly we are expecting that the unemployment numbers would shock and awe through this pandemic process. Very unfortunate for those who have lost their jobs. Now, we think certainly as we move forward to a reopening that there will be a gradual return to growth. Now, we've kept our ear to the floor in terms of having conversations with local operators to understand what impact, if any, it's having on the direct market operations. So on the first of the month, we were calling everyone in our Rolodex to understand how rent collections had trended on the first of the month. So through that process, those discussions will continue to influence our relative positioning. But to date, we're very comfortable with our exposures to residential and industrial and defensive daily needs oriented type retail to date. Now, we have maintained a fairly significant double-digit cash cushion, just given the view that we do anticipate the volatility will persist for some time. But we do have that cash cushion, both as a cushion, but also will give us the ability to play offense as we see a resurgence in growth as provinces and states start moving towards a gradual reopening.
Right, so you're playing defensively and having available opportunity money as you see opportunities present themselves over time. Now,
Indeed.
At the bottom of your screen, there is a black bar, and you can click the black bar, and there's a Q&A button. If anybody has any questions to ask of myself or Paul or Kate, please send it along. Just keep the lines open for a few minutes in case somebody has some questions. This is the quiet moment of a presentation. So Kate, do you have any further kind of closing thoughts? You know, I know you've covered a lot of things, but, you know, if you had to sum up today's discussion, because you covered a lot of things, and you had to pull out 3 or 4 bullet points that you thought were important factors as we look at investing in real estate over the next 6 to 12 months, what would you, how would you sum up some of the things that you've discussed today?
Well, I would say that there's no doubt that the pandemic will have significant implications for revenue and cash flow for a number of property types in the near term. That being said, real estate fundamentals, so when I say fundamentals, I mean the supply-demand underpinning many property types and markets, were very strong coming into this crisis. So by and large, landlords and real estate assets were quite well positioned coming into the crisis, both from an occupancy perspective, but also from a balance sheet and liquidity perspective. So most real estate, certainly in Canada, in the US, is owned by well-capitalized investors. And so we're expecting very little in the way of distress selling, which of course would have negative consequences for market value of assets. We do think that real estate valuations, particularly in the core property types where we have the bulk of our exposure, like multifamily, like industrial, will be extremely sticky given the continued strong underpinnings on a relative basis. Where we do see greater risk, certainly as it relates to both ongoing operations, but also on the valuation side, would be those property types that have been disproportionately impacted negatively by the current situation. And that would be hotel and especially fashion-oriented enclosed malls, many of which remain closed today, and we're starting to see a wave of bankruptcies. But on a positive note, there are many segments within the real estate universe that are extremely well positioned and will ride out the storm extremely well. And the discounts available in the public markets today, we think, are excessive. So for investors with some patience, there's an opportunity to put capital to work in some very high quality companies with very high quality portfolios and get paid to wait with a very attractive and, in our view, sustainable distribution.
So Kate, I made a comment at the beginning of this roundtable that one of the things that we're doing at Portfolio Stewards is we're making a shift from more passive approach to investing to a more active management approach. So some of the more passive ETFs and such that are available that we've been investing in, we're looking at making the shift to being more active. Now, would you describe today's environment as a REIT pickers? You know, you've got a stock pickers market. Is this a REIT pickers market where it's going to be really important over the next 12 to 24 months to really be careful as to which sectors or parts of the real estate market that you're investing in?
That certainly would jive with my view, yes. I do think that taking an active approach to both asset class, so property type, and security selection is extremely important in the current environment. Drilling down and understanding the relative positionings of the portfolios, what the tenant health and covenant is underpinning these revenues and cash flows, and understanding the balance sheet and the liquidity positions of these companies to ride through a difficult period.
Yeah, well, that's awesome. So I think it doesn't look like we have any other questions today, so I'm going to wrap up, and thank you very much, Kate, for joining us today and sharing a wealth of information. And you know, we look forward to having future discussions with you as we allocate more and more money to your active approach to real estate. So thanks for joining us, and And
Well,
thank you.
well, thank you, Bob. It's certainly been a pleasure to be here, and wish all on the line the very best of health.
Okay, so we were doing these on a weekly basis. With this one, we made the shift to bi-weekly. Next weekend is the long weekend where we're going to be told, don't go up to your cottage, stay home, which hopefully doesn't deter too many of you. But the next session will take place in a couple weeks. If you have any ideas or comments about some of the thoughts, some of the areas you would like us to cover, please let us know, and we'll be glad to, our ears are wide open. So have a lovely weekend, and we will catch you in a couple weeks.
Thanks, Bob.